How you doing, guys? This is Ryan. Welcome back to the channel. So this week we're going to be talking about how to not lose money in the market. This is actually inspired by Bridgewater founder Ray Dalio. It's his all-weather fund. I actually found this in the book Money Masters the Game, written by Tony Robbins. What was interesting at the time, my wife was leaving her job to kind of be more of a stay-at-home mom, and her retirement fund from the law firm she was working at was kind of sitting in cash. And around the same time, really respecting Ray, reading his book, reading him closer, I said, well, let me give this a shot. So we're actually going to jump into my wife's IRA. Most of our money is put into my 401k because I have an employer match, but this is something I've been kind of playing around with. I only put $100 in here a month, but I wanted to test it out as a strategy to probably use later in life because it's a little more conservative, you'll see, but the returns are still very good. I'll actually insert a clip of Tony Robbins and Ray Dalio talking about the fund. I'll insert the clip here.
Explain.
Yes. Well, I sat down with the famous Ray Dalio, right?
Right.
And I prepared for 18 hours for that interview because he's a genius and there's not that much on him and I wanted to absorb it all. So I got every little bit of it, sat down with him, and it turned out Ray was a fan of my work, which I was touched by 20 years ago. I guess he listened to my program, so he was very generous with his time. And we spent these 3 hours, and in the 3 hours, when I got to the end, I said to Ray, I said, listen, I really want to help the average person, so I got a question for you. I did this with everyone. I said, if you couldn't give your money to your children, any of it, and all you could do would be give them a portfolio or a set of investment strategies or instructions, and they were going to start over and build it, what would it be? And he said, Tony, I spent a decade figuring that out. All my money's already there. My kids' money is there. My money from philanthropy when I'm gone is there because I'm not going to be here, and I want something that'll do well in the future, and I don't know what the future is going to be. Markets are going to always change. I need something that could work in any market. I call it my all-weather fund. Most of us in the business are familiar with it a little bit. And so he explained it to me, and I have a good understanding. And I said, I get it. So what you're saying is the reason why, this was obsessed him. Why is it if I have a balanced portfolio in 2008, I got nailed on both sides?
Exactly.
You know, why did that happen in 2000? Everybody says portfolio theory, this is supposed to protect me, and it didn't work. But he said, as soon as things get better, no one talks about it, we just forget about it. It happens again. It happened in 2000, happened in 2008. He said, I figured it out. When you have a 50-50 portfolio,
Right.
that's 50-50 of where you put your money in assets. 60-40, 50-50, however you look at balanced portfolio, right? But he said, the problem is that's not balanced risk. And this is where people are crazy. I've seen people write things up, they see this in the book and say, Tony Robbins is promoting. First of all, I'm not promoting anything. Every word in this book is from the best investors on earth. Anything that's from me is about the emotions. That I know for 36 years, that's been my expertise. These are their views, but I'll tell you what's amazing. He said, Tony, when you have stocks and bonds half and half, you're not equal because equities are 3 times more volatile. So your risk is 95.5. And he said, so that's why people get killed in 2008. And he said, I try to get this through to people. He said, but all of our people handle it. You know, you manage money for countries, the largest, pension funds on earth. He said, but people don't listen. They look at it and go, oh, this is bond heavy. The bond days are over because inflation's going forward. He said, it's not true, Tony. This fund in the 1970s, it was the worst time for bonds and it was an extraordinary time for all weather because it isn't. It looks overbalanced because in order to get the same level of risk, you have to go for more long-term bonds or you have to use more leverage on the bond side. And so when he was all done, it was, for the average person complex, I'm seeing financial people look at this and write things up that are just silly, saying, this is never going to work because we're in the, interest rates are the only place to go. If interest rates go up, it's a balanced fund. The other areas kick in. But here's what's interesting. After he told the whole thing to me, I said to him, look, this is wonderful. You've given me something that very few people understand on the planet. I think I really got it. And I played it back to him. He said, you got it. I said, but here's the problem. The average person is never going to know what to do with this. And I said, I'm trying to help somebody that needs to know what to do. I said, you're telling me to make this beautiful chocolate cake, and you're saying, Tony, here's how to do it. Use some sugar, right? Use some chocolate, use some dairy products. I need to know the amounts, give me the amounts. He goes, Tony, that's my secret sauce. And that's when he told me, he said, look, 10 years ago, for you to even get in to talk to me, it was $5 billion net worth, $100 million to get in. And he said, and now for 10 years, I haven't taken anybody's money. And so you answered your own question. I said, you're not taking money anyway. It's not going to compete with you. The average guy, he says, never going to make it talking to a wealth manager. Tell me what to do. And he's so generous. He's giving up half his net worth like many other people. And in the end, he said, okay. He said, but it'll be complex. I said, I can make it simple. He said, well, I don't want leverage in it. I said, design one without leverage. He goes, it won't be perfect. I said, I don't care if it's not perfect. Your idea of unperfect will be somebody else's idea is the best thing they could do. And he laid out the numbers. We ran the numbers and used the same back testing. So you saw year by year how it really did over the last 75 years of modern investing. And here's what's amazing. Like all weather, similar. In 75 years, it's been right 85% of the time. What's even more extraordinary, Is the 15% when it wasn't doing well, when it didn't do well? Its average loss was 1.6%, not 50, 40, 30, 20. Think of the last 10 years, the two 50% hits. His biggest loss in 75 years was less than 4%, minus 3.95. And that was 2008 when the market exploded, down to 51% from peak to trough.
All right, so what is the all-weather fund? The all-weather fund, essentially what it is, it's all about asset allocation. Markets go up and down. Different assets will move up and down at different times. Ray believes he's found the formula to really offset the volatility and return very good returns. Tony actually pressed Ray and said if you couldn't leave your children your billions of dollars of net worth, what would you leave them with if it was just a set of guidelines to invest? And this is what it was. And it's very counterintuitive because we'll jump into it, what the fund is and how it's performed. So what the fund actually does is it puts 40% of the total cash value into, well, I'm gonna say this painfully because the interest yield is not that awesome, but 40% into long-term treasury bonds. And this is actually an ETF of over a 20-year basket. And I'll tell you exactly which one. It's ticker symbol TLT, iShares 20+ year treasury. And it yields, the reason I say it's painful, is about 2.46%, which is pretty much stable with inflation. Right now we know interest rates are low, they've been low for a long time, they're historically low, and they're returning, if you're lucky, somewhere near inflation. And 40% of this fund actually is invested in that. So it really kind of helps, which you'll see later, downside risk, as it'll always return that low yield. And then if you didn't think that was enough bonds for you, it has another 15% into short-term bonds. And that is actually ticker symbol IEF, iShares 7 to 10-year treasury. And the yield on it is very similar to the long-term yield. 2.28%. The yield curves are nearly inverted. You would think when you give your money away for a longer time, you get a much greater return, but you're getting like 0.2, like a quarter better return, whether you lock up your money for 7 to 10 years or 20 years. Very strange, very strange. But when I did this fund, I was really kind of concerned about volatility too. It's going back 3-4 years ago. I wasn't as educated as I am now. Not saying I still don't want to do this fund. I'm probably going to make some of my own adjustments in the future, and I'll kind of explain that as we get into the next part of the portfolio, which is 30% into equities, and specifically United States equities. I buy the Vanguard Total Stock Market Index, ticker symbol VTI, and that takes up 30% of the fund. So we're up to 85% of the fund vested. Now the other 15% goes into commodities, specifically 7.5% goes into the GLD. That's the ticker symbol. Gold is what it is. It buys gold, and this is something that's supposed to act in a way. When markets go one way, gold kind of zags the other way, and to offset. And actually, gold has had a good month for some reason. The other 7.5% is the DBC ticker symbol. That is just a basket of commodity items. It could be anything from oil, gas, nickel, copper, any other assortment of commodities, wheat, corn, anything like that. So it's kind of that basket that will offset, hopefully, rainy days in the market. Commodities kind of tend to rise. So that's the asset allocation. Again, to recap, 40% into long-term US Treasuries, 15% into short-term US Treasuries, 30% into the United States stock market, 7.5% into gold, and the other 7.5% into commodities. So, do you think I'm crazy? It's very counterintuitive. This is very counterintuitive. Before we jump into, Ryan, you're crazy, you're putting all your money into bonds and you're getting 2%. What is my actual return? And am I okay with it? So, jumping into it, right now the fund is up to $18,905.87. And a little tip, I put the money into an IRA account with Merrill Edge. They're a Bank of America owned company. And if you keep at least $20,000 in a Bank of America account, you become what's called a preferred member. And you get things like better credit card points. They'll give you an extra 25% on your cash rewards. So if I get $100 in cash rewards, they'll give me another 25 bucks because I hold X amount of cash. And they also will give some preferred interest rates. If you go to buy a mortgage or a car, they will be a little more competitive and give a break to preferred members. So this kind of helps with that as well. So that's why I don't mind having my money parked over here. But how is it performing? So let's go now to accounts, historical performance. Okay, let's go year to date. We're close to July. How are we doing this year? The year to date return is 11.33%. That's a good return. I like that. Making 11.33% in a very risk-averse type account. I am happy with that. Now that we have that number, let's give it a benchmark. The benchmark number that I think everyone likes to look at is the S&P 500. So how has the S&P 500 performed in the same time frame? The benchmark against any investment return is always good to go off the S&P 500. If you don't know what the S&P 500 is, it's a basket of the United States top 500 companies. So in the same time frame, the S&P 500, according to money.cnn.com, has returned 17.7%. So that's a much better return. I'm not gonna lie. For an extra 6%, you're subjected to a lot more volatility by just holding the market. And what I mean by that is, for example, in 2008, the S&P went down about 37%, and all weather went down 3.95%. The all weather fund has only gone down 4 times, I believe, in the history, at least when the book was written. And that was its biggest loss, was under 4%. So you don't have the same kind of volatility, which is an advantage. And then jumping into it, I've had this fund for 2 years. So looking at the historical performance since I started it, let's jump over there. It's returned me 14% for each year. If you want to annualize that, it's returned on average 7% a year, which is fairly decent. Compounding over time, that'll do very well. In a year-to-year time frame, it won't seem too crazy. It beats inflation. It's a steady return with low downside risk. In that same time frame, the S&P 500 has returned about 17.5% within the 2 years. So
17.5 divided by 2.
You're getting an 8.75% annualized return versus all weather returning 7% even. So you have to ask yourself, for an extra 1.75%, is the downside risk worth it? For me, I'm going to change my strategy moving forward. When the market pulls back, I want to go a lot heavier into equities, and I may even look to get some international exposure, which this fund does not offer. Maybe REITs, or who knows what else I may want to add in here. I wanted to make this video kind of documenting to say this is what I did. It was a tool, and I think for people that are older, close to retirement, I do think this is a solid tool. If you're older and the market drops 20%, watching your retirement fund fall by hundreds of thousands of dollars, it's probably not very fun. You can get a similar return, probably a little bit less, maybe by a point or so, but not have that downside risk. I'm really glad that I've tried it out. I'm younger and a little bit more educated. Maybe I can find ways to get a little bit more better return. But what do you guys think? What do you think? Heavy bonds like that and still getting comparative returns to the market? Only 30% in equities. You have that 15% of commodities and GLD, and then the bonds are gonna be steady over there. It's interesting. I thought being that bond heavy, the returns would be much worse than the S&P 500, but it's actually relatively comparative in the last 2 years. I think it's a good tool for a lot of people, and if it's good enough for Ray Dalio, the man who's made more money for investors than any other human being to ever live, it might be good enough for you. For me, again, I'm not putting a lot of money into this account. I literally put $100 in a month, and I buy whatever has lower asset allocation at that time to bring it to that level. And the reason I don't go too crazy at this account is because something you should consider, and actually Chris and Best mentioned this in the comments in one of my videos, is that retirement accounts are taxed when you pull it out as income, but if you just invest the money in a regular account, and if you hold those long term, you will actually be taxed as long-term capital gains, which will be cheaper than income taxes. Long-term capital gains is what, 15%, and income taxes well over 20%, 25%. You could say 10%. Definitely something to consider. That's why I don't want to go too aggressive with this. I do like knowing this account's here and like adding a little bit more money to it. I definitely want to add more aggressively. I'll probably get a lot more aggressive next time the market pulls back in a drastic way, maybe 20% or so in a recession. I don't know when the next recession is going to be, but I think that's the time I may want to change the asset allocation. I might go 40% at the VTI, the total stock market index. That's a strategy I'll do. Please put your thoughts down in the comments. If you have not already, please make sure to subscribe to the channel. This channel is all about documenting my experience to financial freedom. As you can see, I'm pretty transparent with my investments here. This is my investment account. I wish it was more money. We have more money in mine, but I just want to document the journey and kind of share any insightful information to anyone else that can find it useful, and have a dialogue down in the comment section. And also follow me over on Instagram. I post there pretty much daily. And last thing, hit the like button, and I'll see you in my next one.